What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. In this week's video, I'm going to be going over a very interesting ETF, one that pays a very high distribution and has caught a lot of investors' interest. Is it any good? Is the high fee worth it? And overall, what does this fund contain in terms of total allocation? Because it is definitely a different type of ETF than you are typically used to seeing. It is not all equity. In fact, it contains a wide variety of holdings in order to increase the overall distribution. With that said, let's dive right into it and go over this ETF. So everybody, as always, head down below, like the video, subscribe to the channel. Make sure you comment and let me know what fund you want us to look over next. We give away free subscriptions to random commenters, so it takes 5 to 10 seconds. You could end up winning a $300 a year subscription. And as always, no BS newsletter 2 times a week. We send out stock picks, market commentary, market research, case studies, anything you can think of that's going to help you become a better investor. And it takes 5-10 seconds to sign up in the link in the description below. So the ETF we're going to be going over today is the iShares Canadian Financial Monthly Income ETF. It trades under the ticker FIE.TO, and this is a very popular fund among the income community, particularly because of its high yield. At the time of me filming this, it yields 6.72%, and its overall objective is to maximize total return for unit holders, consisting of distributions and capital appreciation to provide unit holders with a stream of cash distributions of 5 cents per month or 60 cents per annum. Now, we'll get into it in a bit, what happens when the fund gets a bit of a shortfall and doesn't actually generate that income, but I'm not going to discuss that now. I will get into it though. So there can be no assurance that FIE will achieve its stated investment objective, including making distributions at its targeted rate. So it aims to pay this every single year. However, there is absolutely no guarantee that it will pay that. That's the investment objective of the fund, but it states right here that there can be no assurance that the fund will achieve its stated investment objective. Currently, it is paying 48 cents per annum. When we think about this, it has a total share price of $7.14, and the yield checks out at around 6.72% at 48 cents per annum. So you are not getting that 60 cents per annum, and I'm going to discuss why in just a bit here, but a lot of the underlying holdings in this fund have struggled as of late. Now, in terms of total fees, YChart says 0.8%, but as I always say, go to the fund provider's fact sheet to find the actual fees. Sites like YChart, sites like Yahoo Finance, Reuters, they don't have the most accurate data all the time. Most of the time, these sites are going to be very reliable, but ultimately, the way to get the actual fees of the fund is to go right to the source, and you're going to go to the fact sheet of the fund or the website of the fund, and we're going to see here that the management expense ratio of FIE is actually 0.85. So this is as of February 29th, 2024. I highly doubt the fund has changed much in terms of fees. It's possible that it went back down to 0.8 and they haven't updated the fact sheet, but you're talking like 2 weeks. So I would bet on the fact that the management fee is 0.85. So you're going to pay $8.50 a year per every 1,000 you have invested. This is a very high fee. This is an actively managed fund, so it's not an index fund. It doesn't track any sort of particular index. The management attempts to add and remove holdings relative to achieving their target, which would be that 60 cents per annum income goal. But as a result, you are paying a higher fee with this. Now, I'm going to get into whether or not that fee has been justified and whether the performance of the fund has been all that solid just in a bit. But first, I want to show you what this fund is made up with. So if we go to total allocations, we'll notice that most of the ETFs we've talked about are 100% equity ETFs. FIE is 70% common stocks, 20% preferred stocks, and 10% bonds. So I am not going to go into the differences too much of common stock and preferred stock. The one thing you need to understand is that although preferred shares are still an equity investment, they operate much like a bond. They're going to be inversely related to interest rates, meaning when interest rates rise, prices often go down and vice versa. They tend to be a little less volatile, but that's not guaranteed. They do not have any voting rights, but they also have typically a much higher distribution than the the shares of common stock. There is a ton of different varieties of preferred shares. It's not just, one sort of preferred share. They have numerous ones that are callable, ones that are floating rate, things like that. But the main gist of it from this video, this is not all a common stock ETF like you see with many Canadian dividend ETFs. It has bonds and it has preferred shares. So this is a pure Canadian fund, 100% Canadian exposure practically. The majority of its bonds, out of the 10% that is bonds, pretty much all corporate. They're all corporate bonds. So this would be typical bonds issued from Canadian corporations, not, Government of Canada bonds, municipal bonds, provincial bonds, things like that. There's not much of that. And when we look to the overall market capitalization of the holdings, for the most part, this is a large cap, giant cap fund. It's going to contain blue chip Canadian holdings. Now, the majority of the bonds in the portfolio, they're going to be BBB rated. So these are a little bit lower rated bonds in an attempt to probably increase the income paid by the fund. Now, BBB bond is definitely still a very secure bond. And when we look to the other portion, we have, 37% of the portfolio in A-grade bonds. Now, most of the maturities, which actually makes a big difference in terms of overall pricing volatility, most of them are going to be intermediate term, meaning anywhere from 1 to 10 years. And the bulk of this fund, we're looking at 50%, are bonds that mature in 1 to 5 years. So these are going to be the bonds that are the least volatile based on the movements of interest rates. When we look to the overall stock allocations of this fund, it is pretty much purely finance with a little bit of real estate exposure. So this is very, very important to understand if you're holding this fund and you might own, say, other Canadian financial stocks and you have this fund. You need to pay attention to how much you're allocated to the Canadian financial sector by owning this thing. It is very, very heavy in Canadian finance. And when we go to the actual holdings of this fund, you're going to figure out why. So when we look to the total holdings, we can see that the top holding, the 20%, the iShares Canadian Preferred Share ETF. So the holdings inside of this fund are just a wide variety of preferred shares. So we have Royal Bank, we have Bank of Montreal, Toronto Dominion, Fortis, TC Energy, National Bank, Enbridge, Canadian Imperial Bank of Commerce, things like that. So this does have some preferred shares from other institutions that are outside of finance, but I think what YCharts is doing here is they probably consider CPD to be a financial type ETF, so it's allocating it to financials. But make no mistake about it, this fund has a ton of finance exposure. Then we have XCB, which is the iShares Canadian Corporate Bond ETF. This is a fund that pretty much contains purely Canadian corporate bonds. So we can look at TD Bank, Bank of Nova Scotia, Royal, Bank of Montreal. Now, this fund contains over 1,059 corporate bonds. So you actually have relatively high exposure to a wide variety of Canadian companies with this bond ETF. So this is how the fund gets its fixed income exposure. It just buys two iShares ETFs instead of owning the individual bonds. But now when we go down to the total individual holdings, which would be the equity portion, the common stock portion of the fund, which, by the way, it has 30 total holdings. So you're looking at 28 holdings in terms of individual stocks and 2 ETFs that give it its fixed income and preferred share exposure. So the top holding as of right now is Manulife Financial. We're looking at Manulife, Royal Bank, Canadian Imperial Bank of Commerce, TD Bank, National Bank, Fairfax Holdings. The financial exposure in this fund is huge. So it certainly isn't an equal weight ETF. When we look at Manulife Financial's exposure of around 7.16%, and then we look at the bottom end of things, Laurentian Bank at 0.7% and Choice Properties at 0.65%. It's definitely very top heavy, but it's top heavy in some pretty strong companies. I mean, most of them are major insurers, major banks, big six banks, things like that. So it's top heavy in probably, I would say, the companies that many people wanted to be top heavy in. But overall, in terms of total holdings, just pure Canadian finance exposure. So how has the fund done as of late? And if we go to the overall performance of the fund, it's pretty hard to benchmark a fund like this to see how it's typically performed. I mean, when we look to the returns on an annualized basis over the last 10 years, It's returned 7% annually. And when we compare this to the TSX, it has underperformed the TSX, but this is not really a fair comparison, I would say, because this fund is 30% preferred shares and fixed income, which have not really performed all that well over the last decade. You know, we were in a massive bull market since pretty much the end of the financial crisis. Now, 7% annualized is really not all that good, considering when we look at most major indexes, including the TSX, they've outperformed this fund. But when we look to another dividend ETF, Canadian Dividend ETF, and that would be XEI, which is the iShares High Dividend ETF, has actually outperformed this ETF by quite a bit. You're talking around 0.8% annualized, which does end up, over the course of 10 years does end up being, a bit more in terms of total returns. But overall, both of these funds have kind of struggled just relative to buying a straight up index or a, bit of a more total return based fund. Now, what could be a catalyst for this fund's performance to improve? Remember when I mentioned that, most bonds and even preferred shares are inversely related to interest rates. That means when interest rates go up, prices go down. And when we actually look to the overall performance of the preferred share and the corporate bond ETF funds, we begin to see why this is the case. Let's look at the preferred share ETF. We can see that it traded around flat up until the pandemic, and then we can see that it lost value. And that is one of the important things to note about preferred shares. They can still be pretty volatile. They're still equities. They're different structures. And, in terms of the totem pole, you're a little bit higher with preferred shares. But we can see that it dropped during the pandemic and then it started recovering, and then they actually performed quite well. Why? Well, because during this period, we were practically in a period of free money. You were looking at, a quarter basis point policy rates. When rates go down, preferred shares tend to do better. If we look up to 2022, we can see that performance, dropped off a cliff. They pretty much gave back all their gains. And what happened in 2022? Well, interest rates started going up. The value of preferred shares went down. It's going to be much the same case in XCB. We can see that it was going up prior to the pandemic. It fell during the pandemic, and then it recovered quite strong and stayed elevated during, the period of high interest rates. But when we look to, again, what started happening in 2022, well, interest rates started going up, and we can see that it practically gave back all its performance, and it traded relatively flat for, a period of almost 2 years. And then when we look to the, start late 2023, started 2024, it started recovering a bit better because the market is likely anticipating a cut in policy rates. So that brings me back to the situation of what could be the potential catalyst for a fund like FIE to perform better moving forward. It could be the drop in interest rates. Now, this is a very financial heavy ETF. Banks are going through a ton of provisions for credit losses. Net income is being impacted. Earnings per share is being impacted. With a drop in interest rates, we could see some relief in terms of Canadian purchasers, consumers, which could end up putting some relief on the banks in terms of their mortgage portfolios, things like that, which could end up increasing in price. And then when we think of these fixed income elements, there is a chance that their performance could be elevated as well. It's never a guarantee, but this is, something that could be a catalyst for this fund to get out of its, overall drag in terms of returns. Now, would I own this thing? Not necessarily. I could see the value of FIE for somebody who really wants, the high yield. You're paying a crazy high fee to actually have access to this. The yield could potentially be higher if it gets back to its 60 cent per annum target. But again, I'm just not really that big of a fan of Canadian dividend ETFs. I believe a lot of people who are buying these don't necessarily need them. They're just kind of trying to chase yield and, buy higher yielding investments, believing that somehow in order to have that passive income snowball, as they call it, they need to, invest in higher yielding shares so that they can compound better, drip a higher yield, when in reality, it doesn't really make all that much of a difference. This fund has really lagged, primarily due to its high fee, but also due to its bond and fixed income exposure. I could see some potential recovery in the event that interest rates come down. A lot of the companies and holdings inside of this fund do stand to benefit a bit if interest rates do come down. But overall, I'm just not a gigantic fan of this fund. I would not own it. If you own it yourself, I'm not here to tell you how to invest. I'm just here to provide an objective, point of view on the fund itself. So as always, everybody, head down below, like the video, subscribe to the channel, comment down below. That way you get a chance to win a subscription to Stocktrades Premium. It's a $300 a year platform. No BS newsletter, that is down in the description as well. 2 times a week, we are talking about stock picks, market commentary, case studies, all that stuff. Takes 2 seconds to sign up, and it's going to be worth your while. And as always, stay tuned for more great Canadian videos.